Want to welcome everybody to the first of what we hope will be a monthly educational / networking. Hopefully we'll be able to do it in person relatively soon, but we'll operate on Zoom right now. One aside, if anyone got an email from me asking them to click on a link, don't do it, delete it. I was hacked today, but that's another matter. First, I'd like to thank Steve Kirby from Kirby Real Estate for sponsoring our event today, and he's also going to act as our co-host. I should probably say I'm Tom Sweeney. I'm the president-elect of the Rhode Island Commercial Appraiser Board of Realtors. I'm hoping that you find this educational and helpful in your careers. And if you have any other questions about RICABOR, please reach out to Jack Hudson, our executive director, or any of our members. We're more than happy to share information with you. We have a couple of other ones planned the next couple of months, which we'll be forwarding information to you relatively soon. But you're not here to hear me talk, so what I'm going to do right now is hand it over to Steve Kirby, and he'll introduce our speaker and act as our moderator / co-host. And thank you, everybody, and enjoy the program. And Steve, I give it to you.
All right. Thanks, Tom. I have the honor of introducing our speaker this afternoon. It's Patty Flowers. She is the vice president at the firm called IPX 1031. She's been guiding investors, advisors, and commercial brokers about the 1031 exchange process since 1998. During that time, she's completed thousands of exchanges. She is a treasured resource for many in the legal, accounting, and real estate communities. Through her pursuit of excellence in this field, she's been awarded the coveted Certificate Exchange Specialist designation. So we are very fortunate to get on our busy schedule, and so please sit back and enjoy and learn all about the wonders of the 1031 exchange. So Patty, it's all yours.
Along with the 7 wonders of the world, right? 1031. Well, thank you all so much for having me today. It's great. I'm honored to be the first webinar in your series. So hopefully everyone can hear me okay. And my goal today in the next hour or so is to just kind of touch on some general points about 1031 and also some advanced topics, because I'm sure many of you have been involved in 1031 exchanges for yourselves or with your clients. So I'm also going to hit on some of the more, reverse exchanges, partnership and LLC issues. And we'll also just cover a lot of the dollar value rules and things that I think are kind of a problem week to week, that a lot of misunderstandings. So we'll get right started. As Steve mentioned, I'm with IPX 1031. Our full name is Investment Property Exchange Services, but we're really IPX. And I'm part of the New England region. I manage the New England area, but I'm part of the Northeast region. Our company, IPX, is the largest QI in the country. We've been in business over 35 years. This is all we do, all day, every day. And we pride ourselves on really trying to be the expert and the go-to people for 1031 for you, for other advisors, and for your clients. So we'll just get started here. In the 1031, a lot of times people will call and say, hey, want to do that tax-free thing? And I try to remind people that although it can be tax-free down the road, and we can talk about that later, really in the year that you do an exchange, it's a tax-deferred exchange, which means that whatever your basis is in the property when you sell, that basis carries forward with you to the next property when you purchase as part of the exchange. So it's following you on paper from property to property as you exchange. So you can take care of the gain and the loss with this. So obviously nowadays, many of your clients have a gain on their property when they go to sell, but there are certainly times, as it's so cyclical, that clients may have losses or break even if they sold property. But if they've owned it for a long time, the depreciation recapture tax could be still a big hit, even though they don't have a gain. So clients, even in a down economy, will do a 1031 exchange to save on the loss and also to carry that forward, as well as to save on the depreciation recapture taxes. So in a 1031 exchange, a lot of times clients will ask, well, isn't it just 15%? And I always say, no. A lot of tax advisors may say, oh, it's 15%, not a big deal. But they're not taking into consideration all the taxes that would be due upon sale. So when you have a property and you're selling that, if you have a gain, you're going to either have 15 or 20% as your federal capital gains tax. And that really depends on, for individuals, it depends single versus married, what your threshold is. But and certainly trusts and entities all usually are at the 20% mark for the most part. The other federal capital gains tax, under the 2013 healthcare tax, you may recall that if clients have a net investment income a certain year and then they sell property, they may owe an additional 3.8 tax on the property that year. And again, for individuals, single versus married, there's a threshold that you have to meet in order to owe that 3.8. A lot of trusts and entities automatically owe the 3.8. Again, something that they would check with their tax advisor on, but in the scheme of things, that's generally how it rolls. Anytime you're selling property, if you've taken depreciation over the years, the IRS wants some of that back. So when you sell property, investment property, the gain due to depreciation is at 25%. Sometimes they call that the depreciation recapture tax. And then the fourth tax, of course, is the state capital gains tax, and that varies from state to state. If you're in Rhode Island, I think it's right around, isn't it 6 or 7%? But every state is different. Mass right now is 5%. Connecticut's much higher. New York as well. So when you total all of these up, usually it's about 25 to 30% of whatever your gain is. If you sold that property outright, you'd have to pay that in taxes. So that's just a round number. 25 to 30% in taxes would be due if you sold property. So obviously that's the number one reason why anyone wants to do a 1031 exchange, right? No one wants to pay the taxes. So it's really a matter of keeping the equity working for you. So instead of selling property and having to pay out $30,000 or $40,000 or $50,000 or whatever the number is, and then go buy something, instead, if you set it up as an exchange, the owner gets to keep that $30,000, $40,000, $50,000 with them and roll it into new property. So it gives them more buying power, more equity to move into other real estate. And we'll do a couple of examples as we go along. So here, when you run the numbers, I wanted to go over the dollar value rules because I think there's a lot of misunderstanding. Week to week, we have advisors and taxpayers who misunderstand how much they have to reinvest on the other side for purchase. So I wanted to go over this with you all quickly. When you do a 1031 exchange, and this is easy math, round numbers, picture perfect scenario, right? You're selling a property for $1 million. Your basis is $100,000, so you've owned it for however long. And you're going to do a 1031 exchange. If you didn't and you sold it outright, you'd owe about $225,000 in taxes. So again, like I said, if you pay those taxes from a sale, you just have whatever equity is left to reinvest. And of course, this one assumed no debt, but sometimes people have debt, of course. So in the scenario where you do it as an exchange, even though you have that $900,000 gain, because you do a 1031 exchange, and if you follow all the rules in the middle, you can actually defer 100% of those taxes and roll everything on to the replacement property. So again, you're really saving quite a bit by selling versus exchanging. And we'll do some dollar value examples as we go. So why would anyone want to do an exchange? Of course, no one wants to pay the taxes, right? That's always the number one reason why anyone does an exchange. But there are plenty of other reasons. Cash flow. You can actually sell raw land and buy an improved property. So you might have a piece of land, or your client has a piece of land that they were holding. They thought they might build on it, but they didn't, or they inherited it, whatever the case may be. They're paying the real estate taxes, but it's really generating no income. So they might do a 1031 exchange, sell the land, and buy a multifamily or an apartment building or a commercial building that's going to automatically generate cash flow right away. I already talked about depreciation and the chance that you get to defer that when you do a 1031 exchange. But sometimes clients who've owned property for many years are fully depreciated. So they might be talking to you about selling and saying, oh, I can't get the write-offs anymore. It's fully depreciated. I don't know what to do. Well, if they go on and do a 1031 exchange, as I mentioned, that basis, the depreciation, everything follows you on paper. But if they go on to buy a property of greater value, they can start to take depreciation deductions again. So if they sold something for $1 million and they bought something for $1.2 million, that new 200,000 window, they can take the write-offs for. Sometimes that's their reason for wanting an exchange. Joint ownership problems. We'll talk about vesting and partnership issues later on. But in a 1031 exchange, sometimes John and Dave might have bought a property together, thought it was a really good idea, and 3 years later, John and Dave want to go their separate ways. So they might do an exchange, sell the property, and John might do an exchange and go on and buy something else. Dave might take his money and pay the taxes. So as long as they're tenants in common on title, they can actually go their separate ways at the sale closing. If they're a partnership or an LLC or a taxable trust where they're linked in with other people under the same EIN, they have some other issues to work through, and that's what we'll talk about later. When we talk about like-kind property, it's very, very flexible. You can mix and match types of properties, sell and buy just about anything that's investment. So some clients might say, I'm sick of managing the property and the tenants and the toilets and all that stuff. And they want to sell, but they don't want to pay the taxes because they're going to lose so much of what they earned over the years. So they might do a 1031 exchange and try to reduce their management burdens by going into hands-free property. There are properties either from a tenant in common perspective or on the security side, similar to a REIT. There's programs called DST, Delaware Statutory Trust Programs, and those are hands-free. So you put your money in, it's kind of like a fund, except it qualifies for an exchange. So you own just your percentage. You're not in a partnership. You're not linked to any other people. You're not beholden to them. You're on title as a beneficial interest for your percentage of this $60 million Amazon property or 2,000 unit apartment complex or whatever. And some clients want the hands-off management. They're tired of managing the property, but they want the income and the tax deferral. Sometimes clients will do a 1031 exchange with estate planning in mind. So they might sell a property and buy 2 or 3 as replacement. So in an exchange, you can sell 2 or 3 and combine the money to buy one big one. You could sell one larger property and take the money through the exchange and buy 2 or 3 replacement properties. So you can mix and match. And so I've had clients who've said, well, you know what, I really want to buy 3 replacement properties. I have 3 kids in their 20s. Nobody wants to deal with my business and the development and the rentals, but I want to be able to leave each property to each one of the children. So they might do a 1031 exchange, and from an estate planning point of view, leave it to their children, because what happens is when you pass away, your heirs get the stepped up basis, which means it goes capital gains tax-free to them. That's a great benefit. People will also do 1031 exchanges, and maybe one of the properties they buy as replacement is a property that's going to be a rental for 2 years or 3 years or 5 years. But eventually down the road, they're going to convert it, quote unquote, to their primary residence. So they do a 1031 exchange and they buy into a property that's a rental now, but they might move into it down the road to make it their retirement home. Again, a good estate planning tool. We have a lot of clients who are professionals, they're small businesses, restaurants, liquor stores, machine shops, auto body shops, gas stations. We have some very large clients, multi-million-dollar clients that do exchanges. They're moving their warehouse from one facility to another. They all do exchanges with their real estate. You cannot do exchanges any longer with the business side of things. So personal property, equipment, things like that are not exchangeable. But the real estate, the land and buildings in any business that you own is exchangeable. So again, like-kind property, that like-kind term is really misleading. It's very, very flexible. It really is not what it looks like or the type of property. So it's not a condo for a condo, an apartment building for an apartment building. You can mix and match, as I said. It's really how you use the property. So it's like-kind in that you use it for income production or for investment. And then you go on and buy a new property in the exchange that you also use for income production or investment. So that's how it's like kind. You want to look at this bottom bullet here, the exchanger's intent. So in 1031, the IRS talks a lot about intent of use. So a qualified property is something that's held for productive use in a trade or business or investment. So if it's residential, that's rental, but as I mentioned, all the different types of businesses that use real estate. The scenario that comes up a lot is flipping properties or developers who want to buy property. They're going to buy a piece of land, subdivide it, run utilities, clear land. Maybe they're building on it, maybe they're not, and they're going to sell those off. So they might be flipping properties in just 2 or 3 months' time from when they bought it, or it might take them a year or a year and a half or more by the time they go through city and town approvals, environmental, et cetera. But their intention the entire time that they own it is to flip it or resell the property and not hold it. So that's where the difference is. So for the IRS perspective, they look at it as investment property versus inventory. If you're a developer or dealer, that's your inventory, that's your business, that should not be exchangeable. But a lot of clients have both. So you may have a client who does some development work, does some work where they buy and fix and flip, but they also own properties somewhere else that are rentals or leased out. So it's not the person, it's case by case, property by property. As long as that property has a history of rental and lease, taking depreciation, expenses, write-offs, et cetera, it's fine for 1031. And I already said this, residential for commercial, industrial, apartment buildings, you can mix and match any way that you want, raw land. You can sell 2 or 3, buy 2 or 3. Sometimes people doing a big commercial deal might be short. So they sell something for $1 million, they buy something for only 800,000, but they have a few $100,000 left over. They might go on and buy a condo somewhere that's a rental. So you can mix and match any way you want. And those properties, the DST down here, Delaware Statutory Trust, those are the properties on a national level that are run through the security side that are good options. And so even though you may not be on the security side, sometimes I'll say to a broker, well, if they don't want to sell the client because they don't want to buy anything else local, maybe this DST option is nice because at least you'll get the selling side of something, even though they're not going to buy with you local on the other side. Just an option. Other things that count for 1031 is leases with at least 30 years remaining. So if your client has a property and it's leased and they have at least 30 years, including the renewal options left remaining on the lease, when they go to sell it, they could do a 1031 exchange. And the IRS considers a lease with at least 30 years remaining like kind to fee simple. So they could sell some type of lease that they had for 30 or more years left, and they could go on and buy straight out the apartment building down the street. Easements are fine as long as they're perpetual easements, they're considered real estate. So there's tricky there because some of the easements and some of the structures of the way cell phone towers especially are created are personal property versus real property. So in personal property side, it does not qualify, but as long as it's set up, I just did an exchange yesterday and it's a cell tower. They were selling for around $950, but it was a perpetual easement. So it did qualify for a 1031 and the client's going on to buy a commercial building. This talks about percentage interest. I mentioned this scenario about John and Dave. So you don't have to own something 100% by yourself. You could be on title as tenants in common for your percentage, and you could do an exchange with just your percentage. The other tenant in common members do not have to continue on in the exchange. Remainder rights, to timber rights, riparian, air rights, those are all state by state. So if those are considered real property in the state that you're in or the state the property is in, then they can do a 1031 exchange. Like up north, we do a lot of timber rights exchanges, you know, thousands of acres of land for very short money, it sounds like, but it's all timber related. What you cannot do as a 1031 exchange. So partnership interests. So if you may or may not be involved in this as a broker, but if you have a group, 3 doctors, and they're in an LLC together and they own the building, and one of the doctors wants to sell their partnership interest or LLC membership interest as an exchange, they cannot do that because interests in entities are not real property. They have to be on title for their percentage as opposed to an interest in a partnership or an interest in an LLC. Stocks and bonds and notes are not exchangeable. You all know your primary residence, any other types of securities or trusts or stocks, none of those are for 1031 exchange. So I mentioned vacation and second homes. I know most of you do more commercial side, but just since you're in Rhode Island and there's a lot of that down there that I do that are vacation and second homes, I thought I'd throw this in. So as of 2008, the IRS put in very specific regulations about vacation and second homes. And so number one, the taxpayer selling the property has to have owned it for at least 2 full calendar years. And in each of those last 2 years, they would have had to rent it at least 14 days or more each year. So that seems simple to do, no problem. But number 3 is really the kicker. And that says that in each of those 2 years, if you could have rented it a couple weeks a year, but you personally are not allowed to use that property more than 14 days per year or 10% of the total time it's rented. So if that property is primarily personal use and enjoyment for your family, your friends, and you do not report rental income or take depreciation, you should not be doing it as a 1031 exchange. And the same goes on the buying side. Going forward, if it's going to be in a vacation or second home area, you need to really be renting it for the next 2 years and using it minimally. And the IRS people say, well, that's crazy. It's an investment. I made money. I worked hard at this property. But the IRS says because it's your personal use, it's not really investment. So there you go. So just a little heads up on that for vacation and second homes. So any of you who have been involved in the 1031 exchanges know that you need a neutral third party or qualified intermediary to set up the exchange and control the funds. So the QI, the IRS says, cannot be related to the taxpayer in any way. So if your client's doing an exchange, you as the broker, their attorney, their accountant, their financial advisor, none of those people are allowed to also be their QI. Because in the tax code, it says the taxpayer cannot have active control of the funds in between the sale of the purchase, and their advisors cannot have constructive receipt, because most often the attorney or the CPA or the advisor or yourself, you've contracted with them to work on their behalf. So you're their fiduciary, you should not be their QI. And that's fine. I mean, everybody has their role, right? So I want everybody on board. I want the broker to understand, their advisors, et cetera, everybody to kind of be in the game together, because everyone has a different piece of the puzzle to explain to the taxpayer. So the QI really is a third party, neutral. We've done multiple exchanges for clients, so that's okay. But in our contract, in our agreement, it says we do not represent them as a tax or legal advisor. So that's why we can do multiple exchanges for clients over the years and continue to hold their funds. So as you know, we set up documentation prior to the sale closing. We would get a copy of the purchase and sale agreement. Legally, we assign into that to be able to receive the cash from the closing attorney, title company, whoever's handling it at closing. And then we wire the money into that purchase closing. And so the big point down in the bottom here is that if it's a regular forward exchange, it goes deed directly from seller to buyer. We are not on title, not on the deeds at all, and not involved in any negotiations in a regular forward exchange. We will talk about reverse exchanges towards the end where we do take title, but most exchanges are regular forward exchanges. You sell first, funds go through the QI, then the client goes on to buy replacement property. And again, everybody has their role. We don't take the place of the brokers or the attorneys or anybody. So in the exchange, this is a matter of course for those who haven't done one, where the QI down the bottom. We prepare exchange documents with your seller, the taxpayer. And then at the sale closing, we've already communicated with the closing office, the title company or law firm. The deed goes right to the buyer, but the cash gets wired to us. We hold that money in the exchange account. And when they're ready to buy the new property, same thing. We assign in, the deed goes directly from seller to buyer, but we've sent the money in because the goal is to use all the cash in the replacement property. So we're going to always be working with both sides, closing attorneys, title companies, yourselves, and the taxpayers. So I wanted to cover a few points on dollar value rules because really, as I mentioned in the beginning, every week there's misconceptions, misunderstandings. People don't hear what we say, and we just want to make sure everybody's on board with this. In a 1031 exchange, to be 100% tax deferred, I'm caring about the sale price, what debt do they have to pay off, and what is the net proceeds. So in a 1031 exchange, to be 100% tax deferred, number one, they should be buying replacement property equal or greater to their net sale price, which is the $1 million sale price minus only the closing costs, real estate commissions, tax stamps, recording fees, attorney fees, etc. Number two, their goal is to reinvest all of the cash into the replacement. So in a perfect world, to be 100% deferred, all the sale proceeds after closing are going to get wired to us as the QI. We're going to hold that, and then IPX is going to wire all that money into the purchase closings. If they had any debt on the property that they paid off, they're supposed to match that on the buying side. So they're supposed to replace the value of the debt in the new property with either another mortgage and or new cash. So if you paid off a loan of $400,000 at the sale closing, but Aunt Millie died and left you $400,000, when you go to buy the new property for $1 million, IPX is going to wire in the $600,000, and you could either bring in the cash that Aunt Millie left you for $400,000 and you're all set, or you could get financing for that $400,000 or some combination. So really the goal is equal or greater value, equal or greater debt, and roll all the cash. That's 100% tax deferred. The point is to not receive any cash. Sometimes clients do want to keep cash. So ideally, no cash goes back to the taxpayer. But they might say, hey, I want to keep $50,000 at the sale closing to take a great vacation or buy a car or pay for college, something. So they can keep cash at the sale closing. It's okay. But whatever cash they keep is going to be called boot. B as in boy, OOT. So if you've heard that term, I always say, oh, it's a kick in the pants, right? But really, boot is any cash that you receive at a sale closing that you're going to owe tax on. So you could do an exchange, keep some cash, then it's a partial exchange and a partial tax payment. So let's do a couple of examples here. So in the exchange, the relinquished property is always the one that's being sold. and the replacement property is the one that's being purchased. So in the exchange, you're selling for $750 in this example. We're paying off a mortgage of $200,000, and they're going to have $550 left over. So let's forget about, I mentioned, of course, they're paying right in this amount here. They're paying also the closing costs, the real estate commissions. All of that gets paid at closing. So obviously, maybe you're going to have $510 or $520 or $500,000. This is definitely going to be lower. But just for my example, you're selling for $750. You're going to pay off a mortgage and closing costs around $200, and you're going to have $550 left. The goal is for that whole $550 to be wired to the intermediary. And then on the new side, when you're ready, here we go. Well, we're going to roll that entire $550 into the replacement property purchase. Now you're buying for $825. So you have to show up at the closing with another mortgage of $275 or cash or some combination. So they had equal or greater value, equal or greater debt, and rolled all the cash through to the purchase. No taxes are due. It's 100% deferred. So typical closing costs, as I've mentioned, real estate commissions, title insurance, tax stamps, recording fees, our fee. Sometimes there's other things done. They really have to be typical for the closing. So any mortgages that have to be paid off are going to be paid off, but they're not a closing cost. It's just these items that are closing costs. So if you have like security deposits, prorated rent, things like that, those should be handled outside of closing. So we really want that to be taken care of outside, because if the taxpayer gets cash back, especially like on the buying side, that seller gives them all the prorated rents or the security deposits. If that shows up on their settlement statement, it's going to look like boot. They got some cash. It's taxable. So we want that to be outside of the closing, and only these typical items show up on the settlement statement. So anything else that costs boots, we already talked about this, as I mentioned, like prorated rents and things like that, but also anything to do with a mortgage, like points, loan fees, things like that. Those should all be handled with taxpayers' own cash and not exchange proceeds. So you really want to be careful for that. And again, the attorneys are working with them on that mostly as well. And, we can always help them, but just so you know, that's what they want to be careful for. The other thing that I would mention is if you have excess deposit. So you're holding the deposit for sale, and then you're going to keep your commission from that, but you have excess deposit. Two things need to happen. That money either needs to go to the closing. So a few days before, you need to get in touch with the law firm or title company and get them the excess deposit, or you can wire it right to us, to IPX, for the exchange account. So if you have excess deposit, just try to keep that in mind. If you give it back to the seller after closing, it's going to be taxable. They want that excess deposit to go through the closing and into the exchange account. And I know a few of you are typing in with questions. We're definitely going to go through questions and answers at the end, and I'm going to stay on as long as you want. So, please don't worry about that. So the timeline. So if everyone's comfortable with the dollar value rules, you all know that there are very specific timelines in 1031, and they're not fun. They're very irritating, actually, to us as a QI and to the clients, and consequently to you. But we have to deal with them, so it is what it is. So in a 1031 exchange, day 0 is the day the sale closes. So we always use the settlement statement date. And from that date, you have 45 calendar days to identify what they're going to buy. Everything counts. Weekends, holidays, birthdays, everything. So 45 calendar days goes quickly, and it starts at the day of the sale closing. You have 180 days total in order to close and purchase the new property. So what I usually say to people is somewhere back here before day 0, you have a purchase and sale agreement for what you're selling. You know that you're going to have 45 days. You know you're going to do an exchange. I always tell people to start looking. So I feel like these timelines for a real estate broker, I feel like they're your best marketing tool because you now have a very motivated buyer. They know that they're going to sell and they have this short 45-day window to identify what they're going to buy. So back here, you should be saying, hey, I'll help you look for replacement property. What are you interested in? Let's look it up and let's go do some searches and let's go visit some properties with your mask, social distance, and separate cars, right? So, so you really want to be looking for all of that prior if you can. Sometimes people call, they say, oh my gosh, I want to do an exchange and they're closing next week. Especially right now, that's happening every single moment. So you really want to be the first ones on the scene, talking to them about an exchange, getting them to think about it. And I would remind you that a lot of savvy real estate investors do not understand 1031, or they have misunderstandings, or they just expect that it's going to magically happen at tax time with their CPA. And that's not true. And they get very upset when they call after the fact and want to do an exchange, and I have to tell them it's last minute. So I always think if you're listing properties or talking to someone about it, mention that it's going to be an exchange. If you have a client you're working with that's doing an exchange, ask them when their day 45 is. Say, hey, you're doing an exchange. Let's be looking for the replacement property. You really have a short window. Again, you have 6 months to close, but you have to know what you're buying or have it on a list by day 45. And there are no extensions, none, zero. So even with, presidentially declared disaster areas like hurricanes, wildfires, flooding, those sometimes will get an extension under a certain regulation from 2007, but you can't guarantee it. COVID's a perfect example. They gave a short little extension in April, May, and June up through July 15th, but they did not do the normal presidential declared extension under Revenue Procedure 2007. And we asked them about it consistently and all through the summer and into this fall, like, are you going to give any more extensions? People are having problems finding replacement property. There's a lot of restrictions. And they said no. So you really never know. So you always don't want to count on extensions. You really want to be using the 45 days and 180-day window as your guide. You can identify properties a few different ways. The most common is the 3-property rule. So you could identify up to 3 properties of any value, even if you only plan to buy 1. You can buy 2 or 3, as I said, but you can identify up to 3 of any value. Sometimes people say, oh, you know what, I want to list 5 or 6 properties. Well, the IRS doesn't let you do that very easily. You have to follow the 200% rule. And what that says is if you're going to list 4 or more properties, you have to also list their fair market value or list price. And when you total those up, they cannot exceed twice what you sold. So if you sold for $1 million and you want to identify 5 properties to us, even if you're going to buy 1, but you want to list 5, those 5 cannot exceed $2 million, twice what you sold. So a little bit harder. That 200% rule works best when you're selling a larger valued property and buying a few smaller ones. You can get more on the list. The third choice is called a 95% exception. Not very common. If you identify more than 4 and they're more than twice what you sold, you have to buy everything. It's really hard to do. Not very common, as I said. So you identify up to 3 properties of any value, or you use the 200% rule when you're buying smaller properties. That identification, we have a form for that, and that has to be into IPX by day 45, no questions asked. Last weekend, we sent our 3rd reminder to a client on Friday. Don't forget, Sunday is day 45. He did not send it in until Monday. We can't take it. There's no way, because we have to follow the IRS regulations as the intermediary. He was furious. He did not read our emails. I talked to him about it last week. He wasn't listening, and he probably just forgot. But he's out of luck. It's a big problem. Okay, on to vesting. Investing means how you're on title to property. And so in a 1031 exchange, our job as the QI is to make sure the same property owner that sells is the same property owner that buys the replacement property. And so when you send us a purchase and sale agreement to open an exchange account, we take the seller name exactly how it's on the P&S. So if you put, Johnny Smith, even though it's really Jonathan Q. Smith, we're going to open the account under Johnny Smith. So you really have to be careful to know either, and sometimes like the town records aren't even accurate, but maybe from a deed, like exactly how are they on title to property? You can check with the client or pull the deed yourself, whatever you want to do. That seller name should be exactly as how they're on title, and hopefully that matches how they report to the IRS. We're going to open up an exchange account under that seller name. They're going to fill in a W-9 for us with their tax ID number or EIN number. When they go to buy replacement property and the P&S agreement comes into us for that, we have to assign in the name has to be exactly the same as how they sold. So when you're doing P&S agreements on the buying side, you should say, what is your entity name for the 1031 exchange? And make sure that that's the buyer. Because if it's not, we're going to stop it, send it back and say this has to be assigned or amended to change the buyer name. So you really want to be careful of that, because the vesting rules say the same underlying taxpayer that sells has to be the same underlying taxpayer that buys. So any entity can do an exchange, an individual, a partnership, a trust, a corporation, it doesn't matter, but the same entity, trust, corporation, partnership, individual that sells has to be the same one that buys. There are a few exceptions, of course. So in the cases of trusts, there are old trusts like nominee trusts, realty trusts, grantor trusts. And a lot of those were created years ago, and they're really pass-through entities. They were mostly in name only. So they were disregarded for tax purposes. So if it's a grantor trust or some kind of nominee trust, when they're selling, it's probably they've been filing under their own tax ID numbers. But we have to ask that question, and they may have to ask their CPA. A lot of people have no idea how they file. Even when we say, well, do you get a K-1? Do you sign 2 separate tax returns? They don't know. So you want them to double check with their accountant. The same thing happens with single asset entities. And of course, the most common is a single member LLC. And that's the most common lately. A single member LLC is usually disregarded for tax purposes and a pass-through to the underlying tax ID number. So in that case, a single member LLC can be on title, but it's really John Smith's tax ID number. The same with the trusts. So there's a few variations that are okay. But for the most part, in every first conversation, I always say to people, the same entity that sells has to be the same one that buys. And then we let them say, oh, wait, what about this? Or what about that? If I see that a P&S comes in with a trust or an LLC, we always ask the question. They have to send us a copy of that formation document, a good standing certificate. We really need to get information before the sale can close to be sure. The death of an exchanger, sometimes people unfortunately will pass during an exchange. If the estate wants to finish the exchange, they can. So the big problem that we have is partnership and LLC issues. So we have partnerships or multiple member LLCs that function like partnerships. Also taxable trusts. If you have trusts with multiple members or sometimes family trusts, they have an EIN number, and then it functions like a partnership and sends a K-1 to everybody. So when those entities want to go their separate ways, that's a big problem that has to be taken care of ahead of time. They really need to be talking with their CPA and tax counsel and try to plan as far ahead in advance as possible. So what happens is, say scenario number 1, the partnership owns the property and they want to sell and they want to do an exchange, but some of the partners want to get cash and some want to exchange. So now we have to work with them and their tax advisor. The ideal scenario would be to pay the cash out partners. So the partnership would take some cash at closing, and that CPA would roll it through the tax return, send K-1s, and pay out the cash to those partners. But the ones who want to stay together keep the partnership intact and roll on to buy replacement property. That's a cleaner scenario. The more common scenario, of course, is not as clean, right? The partnership owns property they want to sell, and they all want to go their separate ways. None of them want to stay together. Nobody wants the other one to keep the partnership or keep the LLC. So they really have to just separate ahead of time before the sale closing. And they really should be separating before you even do a P&S agreement. That doesn't always happen, of course. So what happens is that when you go on, the most common, you may have heard of this, called a drop and swap. So this happens when last minute, a partnership or a multiple member LLC as an entity drops the real estate down by doing a deed to tenants in common. So every partner is an individual now on title. Then they have to do a P&S agreement to show those three individuals as sellers. So maybe John wants to do an exchange. So we'll assign in and set up an exchange account for John. Dave wants to keep the cash. And I don't know what Steve wants to do. He maybe is doing an exchange as well. We can open up a separate exchange for each one because they're listed as separate sellers on the P&S. Because again, we're assigning in to receive proceeds for each taxpayer. A drop and swap is not great because the IRS does not like it. Especially if you're on the West Coast, if anyone has property and they're tax related to California, California is all over this. They are trying to make money left and right. And so every single drop and swap, they're watching for it, they're looking for it, and they're trying to unwind it and make everyone pay the taxes. So it's really something that has to be planned ahead of time. They have to determine it. A lot of times partners will go, oh, yeah, let's just do this. We're closing next week. And I want them to go back to their accountant and really have the discussion, because the CPA is the one who has to file at tax time. There's other choices: distribution of real estate, liquidating. There's lots of different choices of how they can do this. And we can talk about this at a later date. But I just wanted to, there are some issues with partnerships and LLCs if they're going their separate ways. What is a reverse exchange? So a reverse is when you have to buy before you sell. So in this type of scenario, what's happening is the client has a property. Maybe they're thinking of selling but weren't ready to sell. And all of a sudden a property comes along that they really want to buy. So in this scenario, they have to buy first and sell second. The IRS will not allow them to be on title to both at the same time. So that's a reverse exchange. We as the intermediary become the accommodation title holder. We actually have to physically create an LLC that's disregarded. We're the member. We have a company name that's the member. And we physically step in and take title to that new property and then lease it back to your client until they're ready to sell the other one. So they're doing it 180 days, but in reverse. So this is a nice, very long example, but nice graphic about it, so that we become like the EAT, an exchange accommodation title holder. If there's a lender involved, this is a really big deal, because if we're on title, we have to be on the loan documents. So my first question is always, how are you going to get the money to buy the new one when you haven't sold the old one? And if they say, oh, I have plenty of cash, no problem, that's fine. But if they say, oh, I have a lender, not all lenders will allow a reverse exchange. And if they're already too far down the road signed in with that lender, the lender doesn't let them out of it, out of the commitment. So really a lot of planning is involved in a reverse. A reverse takes a good couple weeks to set up, but there's a lot of back and forth and emails and conference calls before that to make sure everyone understands. If your client was ready for a forward exchange, they were going to sell first and buy second, and something happens to the sale, there's a big title issue or environmental, and all of a sudden it stops, but they still have to buy in 3 weeks, then it becomes a reverse quickly that has to be set up. So again, a reverse exchange is when you have to buy first and sell second. You cannot just do it on your own and then, funnel the money back later. The intermediary becomes what they call the accommodation title holder, the EAT, and we step in to take title to the replacement property. Later on, when the sale closes, the money comes to us and we pay back the taxpayer. So they loaned us the money to buy the new property, or they got a lender to funnel for the new property. After the sale closes, all that cash coming out of the sale has to be paid back. So, some of their considerations are definitely financing. Number one, is the lender approving of this? Are they going to allow a single member LLC on title? Certainly, they're guaranteeing the loan through their client, through the borrower, and they are underwriting the borrower. But they get a little concerned when somebody else pops in the picture, of course. You always have to have commercial carriers in place that will allow dual insured. You need an environmental phase 1. If it's anything more than a single family or 1 to 4 family, we need an environmental phase 1 current within the last 6 months. It's surprising how many people, if they don't have a lender, they're like, oh, I'm not going to do a phase 1. I don't want to pay the cost. Well, if we're going to come into the chain of title, we have to know that that property is safe or has remedial work being done. Sometimes that is the case. We did a huge property in Rhode Island a year or two ago, one of the mills downtown, and they had everything A to Z wrong environmentally. But we were willing to take title to it because they had a remediation plan in place, the state was involved, and they could show us all the work that had been done and that was planning to be done with some of the exchange proceeds. So we're okay with it if it has some issues, but we need to be clear in what they are, because our parent company is publicly traded, New York Stock Exchange, and they don't love these. So we have to really make sure we're going to stay out of trouble. Also, there's build to suit exchanges or construction exchanges that kind of follow that same scenario. So if your client is selling first, but they're buying something of less value and they're going to immediately make some improvements to it, they can do a construction exchange or build to suit exchange, improvement exchange. So in that scenario, we still also have to take title to the new property, because the minute your client takes title to the new one, the exchange is over. So just to keep in mind, again, it's a kind of its own conversation. It's about a 30-minute in my advanced courses when we talk about reverses and build to suits, but just keep in mind, they can't be done quickly last minute. The QI gets very involved. If there's a lender, there's an extra step. And you really want everyone on board as soon as possible to try to feed everything out. And if there are any changes have to be made, that they're made ahead of time. Reverse improvement combinations. A lot of times this is like restaurants or gas stations, like people where they're moving their business, warehouses, they're moving their business. So they have to buy the new one first, build it up, and then sell the other one. So they're giving themselves time. So that's a reverse. They buy first, they're fitting up the property to do their business, and then they're going to sell the other one, which they might have a lease back as well for a little while. That's okay. So reverse improvement exchanges also help when your clients are moving their business from one place to another. So exchange motives, right? We already talked about a lot of this. Why does anyone want to do a 1031 exchange? So, a lot of these are good motivators for your clients. And I think they don't really know that. So you could actually take some of these topics, and when they're talking to you about selling, they're thinking of using you, talk to them about this. What's your plans? How much cash flow do you get now? What are you planning to get out of the new property you buy? Did you know that you could move? Sometimes it's as much as just moving across town. You might have a property that's older, you're only getting okay rents for it, but if you have to fix it up, it's going to cost so much money. Whereas if you just sold it, did an exchange, you could buy this nice new property down the street, closer to the train, nearer to the city, getting better rents, near the colleges, whatever it may be. So they could do an exchange just to immediately get better cash flow. So these are the things you want to be talking to your clients about when you're doing an exchange. Some of the benefits. So I know, some people have been hearing and calling and emailing us about, they heard little blips over the fall about Joe Biden and, get rid of 1031 exchanges. And if you've all been around long enough, I feel like almost every election cycle in the last 2 or 3, this is a buzzword. I'm getting sick of my job being dependent on elections, but it is what it is. And I think part of the misunderstanding is they use it for a soundbite. And most people in the country don't know what a 1031 is, but they kind of portray it as being just for the rich. Oh, the 1%ers. Everyone who owns investment property is so wealthy, like Donald Trump or Leona Helmsley or whomever. And that's really not so. So back in 2016, this was a little bit of an issue. They were trying to make some changes to the depreciation, to personal property, and they were going at 1031 as well. So we as an industry kind of got together. Our general counsel at IPX is actually leads the pack, which is nice. We're the largest QI in the country. So she is on the ABA board, tax roundtable in Washington, and works with a lot of the groups, all the commercial broker houses around the country, NAR, AARP, the Farmers Bureau. We work with all those groups to help save 1031 because they all benefit. We had a few studies done, and we're having some more done now as well to go as we go into January and February. And some of those studies are really to look at and prove that most people who do exchanges across the country as an average, the property is less than $1 million. So 60 to 65% of all exchanges are actually under $600,000. The East Coast, obviously our Northeast and the West is a little bit different. We have much higher values, but it's an average across the country. And it really preserves wealth for middle class, for small businesses, as I mentioned earlier. A lot of people own a multifamily or 2 multifamilies. That income supports their day-to-day, helps pay for college, or is going to help them in retirement. Those small businesses, as we've certainly seen over the last few months, need that every penny they can get to continue on. It promotes growth. All these related industries, when we talk to House Ways and Means Committee and Senate Finance, what else does 1031 affect? Building, right? Engineering, brokerage, cities and towns, right? They all get tax stamps or, they get recording fees, every registry in every county or city and town. They all get those. That's income to those cities and towns, to the counties and to the state. They need that income and they don't realize what they'd be losing because if people can't do a 1031 exchange to save the money, they might not sell. They don't want to pay the taxes, so they'll wait it out. So it really is more buying power for the client. They get to use that equity going forward, and it stimulates the economy. So this website right here, if you go to ipx1031.com, you'll see on the top right, there's a section that says tax reform. If you click right on that, you can add your name and email address. Because Joe Biden mentioned it in August and September about getting rid of 1031, it's definitely on someone's radar in Washington. We've been working on that, and we've done a lot of presentations for, again, House Ways and Means and Senate Finance, who really are the ones that are going to hash it out. But we will be ramping up again, and we have a link where you can find your congressman. You can send links to them. We have pre-printed letters to save 1031. So if you think it's a part of your business and it's going to help you and your clients and your neighborhood economy, you might want to go to this ipx1031.com. Just click on tax reform on the top right, and you can register to start getting info as we build that up over the next couple months. So just a final screen here, targeting the investors. Like I mentioned before, 1031 is a great marketing tool, not just because those timelines are so quick, which it is helpful to you because you have motivated clients. It's not very fun, of course, but investors who have property owners that have investment property, they're really less emotional about it. They want to think more facts and figures, cash flow. What amount of work do they have to do? Are they working nights and weekends? Do they have management team in place? How are they collecting rents? All of those different things. What kind of tax incentives are out there? And then also in 1031 exchanges, a lot of times there's multiple transactions. Can't tell you how many clients of mine are repeat. They did an exchange. They hadn't done one before. Maybe they sold a property and paid the tax, and then they were unhappy. So they decided, I'm going to do an exchange with this property. They see how it flows. It's easy to do. It's a lot of paperwork, but our job at IPX is to help them through it, make it easier, and make sure there's no missteps along the way. So now they say, oh, well, now that I did that, I'm going to sell this one over here and do an exchange. And in 6 months, I'm going to sell that one and do an exchange. So they start to think like 1031 things. They move their assets around to be able to have the most amount of income and the least amount of taxes. So it really does become a way of thinking for them. And for you, if you want to market to them, I have plenty of brokers, and this is all they do. They just have client after client. They say, oh, do an exchange. We'll help you buy this property. This will save you taxes. And they run the numbers with them, and it's a great, great benefit. So talk to your clients about it. Certainly, how can we help? If you have a client who's thinking about an exchange, or maybe they already have a P&S, the wording doesn't have to be in the P&S to do an exchange. So maybe they're going to close in 3 or 4 weeks, or in January, or hopefully not next week, but maybe give me a call. We can talk it through. I can send an email out, and maybe we can get the exchange set up in time for their sale. So I can be on your side, either upfront with you to talk to the client on a conference call, a group email, or I can be behind the scenes. If you want to use me as a resource, call me, ask me a few questions. You can hang up, call the client, and you can be the hero and talk to them about it. I don't have to be up front. I can be behind helping you as well. So it's a good strategy. If you have local attorneys or local CPAs or financial advisors, this is a good topic to connect with them. If you've been trying to connect with a couple of law firms or title companies, maybe talk to them. You could both sponsor a seminar, and I could speak on 1031 for a little while. You could talk about the market and things like that. You could have a lender come in, talk about the interest rates, whatever you wanted to. So we can help you with presentations and seminars as much as you want, or clients one-on-one. I'm happy to be a resource for any of you. As far as IPX goes, a lot of times what people are asking is, well, I'm going to send all this money to you. Who are you? Patty Flowers out there with money. What is she going to do? And so that might be something as simple as, we're going to hold the funds. They always sit in an escrow account. We never invest the money. It's held there for the benefit of the taxpayer. So they do a W-9 under their tax ID number, their EIN number. The money sits. We don't invest it to make money. They can't pick what bank they want to do. They do get interest on it, but the interest is terribly low right now, so it really is not much. The goal of holding that money is to preserve the equity, to be able to have it to use on the buy side. So IPX, we are the largest qualified intermediary in the country. We have offices in almost every state. I'm part of the Northeast region from Maine down to DC, but I do work in all 50 states, but I'm right here in New England. And we are the largest in the country. We have 100 million fidelity bond coverage, 30 million E&O insurance, a written guarantee of funds that really no other QI provides. We're part of a parent company called Fidelity National Financial. So if you know the title insurance side, there's Fidelity Title, Chicago Title, Commonwealth Land Title. Those are all our sister companies. We're under the same parent. Pretty transparent since they're a Fortune 500 and publicly traded company, but they're super secure and very, very conservative. And for me, that's been wonderful. I've been doing this for 20 years, and I love my company, and I love the security and the backing it provides. And I know when I tell clients that their money is safe and this is how you do something, that I have their backing, and I know it's going to be there in the end. So really, it's the security of funds. It's our experience. All our offices are managed by tax and legal counsel, so we can always help answer questions. But of course, we want everyone to use their own attorneys and CPAs. And again, we give continuing ed seminars and things like that. So, we could do another one of these in the spring if you wanted for continuing ed. But again, if you want to offer even investor seminars, I'm happy to help with that as well. So IPX is really there to help you as much as we can and just to be there for your clients. My contact information is here. And so I think we're going to try to open it up. Steve and Jack might have some questions that were sent in through the chat. And we'll try to get to all those if we can. Hopefully this was beneficial for you today. I really appreciate it. Any questions out there, Steve or Jack? You want to unmute yourselves? Steve, you're going to have to unmute.
Steve, you got to unmute. Yeah, you've got the questions.
Yeah.
There
Okay.
you go.
Luckily, I have a very smart daughter who can figure these things out.
There you go.
So we got a bunch of questions. One of them, Jeff Brooks, I guess he's planning on doing some traveling, wants to know, do exchanges work for territories such as Puerto Rico?
So great question. So any U.S. state and territory except Puerto Rico. So Puerto Rico has a set of their own laws in place, and 1031 is not allowed for Puerto Rico. But the U.S. Virgin Islands, if he wants to take a hop over there.
Okay. I remember, when I first started learning about the 1031, a lot of CPAs or a lot of lawyers were not really familiar with them. What kind of, do you find that other professionals are up to speed with it, or are you educating the professionals at this point?
Yeah, that's a good question. So I'll tell you that my number one referral source has always been attorneys and title companies. They understand it the most. They know the rules. They know about the funds. They know about the vesting. And they're a lot of times probably the number one source. But the minute you start talking about anything tax-wise or partnership LLC issues, a lot of times they want to defer to the CPA. So I do find that they know some, but what we try to do is we have a nice booklet and we have kind of a PDF discussion of everything. So what I try to do is send them that information and kind of point them right to the section in the tax code they should be looking. These are the do's and don'ts. This is what I think they should be looking about. So a lot of times we are guiding the advisors through the Q&A and to try to help them make an educated decision.
Great. When the market is as hot as it is now, and you have to, nominate your 3 properties, are you seeing people run into problems that those 3 properties disappear? And what happens if that occurs?
Yes. So in the 1031 exchange, the 45-day deadline is very, very firm. And so what's happening is exactly what you said. People are listing properties or not even listing them. Like they can't even get to list them because they find a property, they go to look at it, and there's already 2 or 3 offers by the time they get to it. And they may or may not get that. And so in this market right now that is moving so fast paced, people are having problems because everything they make an offer on, they're either outbid or can't get it in time. So the sooner that they can make offers, even maybe before the sale, I try to get them to start looking for replacement property even before they've sold, so that if they want to make an offer to lock it in and get to the due diligence part, it's buying them more time ahead so that they do have something locked in by day 45. You don't have to be under P&S agreement for my benefit by day 45, but just the way this economy is, if you're not locked in, you're probably not going to get it.
Okay. And then kind of a spin-off of that, if the whole concept fails, they don't get one of the 3 properties, how long does it take for the money to be given back to the client?
Yeah, so that's tough. The IRS has very, very specific regulations on that. They call them safe harbor regulations on funds, but nobody thinks it's a benefit to them, for obviously. But if you, so step 1, scenario 1, If you do not identify any property in 45 days, the exchange is automatically over. Whatever funds we're holding will be returned to the client. So if the sale closes on day 30, they say, forget it, I'm done, I can't look for property anymore, I want my money back. We're not allowed to give it back until after day 45, as long as they have not identified any property. If scenario 2, they do identify property in the 45 days, we are required under the regulations to hold the money until day 180. So if they identify 2 or 3 properties in the 45 days, and then on day 60, 70, 90, say, oh, I couldn't get any of these, or I did the due diligence, this one's terrible, this one someone else bought, there's nothing left for me to buy, I'm done. We cannot give the money back until day 180. And this is a terrible rule because it just shows how old it is. I mean, actually, 1031 Exchange's anniversary is next year. It's going to be 100 years old, 1921, if you can believe. But most of the regulations were in the 70s and 80s. And I guess, I mean, real estate must have been moving slower then. It really wasn't as big a deal because these rules don't make sense in today's economy. But they think if you identified 3 properties and you change your mind after day 45, we should hold it until day 180 as a QI just to give them every opportunity to buy it. But they might be already sold and gone. So they can't do that, and they cannot go back and identify something else. So we should be able to give the money back. So it's a very tricky situation. Our company specifically has a form that the clients sign, and the heading is called, very technical, when can I get my money back? And we try to outline this as clear as possible, but it's a difficult situation.
Okay. We've got a couple questions just about the cost of this, both for a traditional exchange or for a reverse exchange. What should a client expect as far as it adding to the whole transaction cost?
Yeah, so most of the commercial deals, 1031 exchange, a regular forward exchange is just a flat fee of $1,500. And that covers everything for one sale and one purchase. If you had multiple properties, like you were selling 2 or 3 or buying 2 or 3, it's just an additional $200 for the additional properties. The reverse and the improvement exchanges are priced case by case. It really depends on the type of commercial property or apartment buildings, the environmental issues, the lender, a lot of factors. So a residential rental reverse, so like a 1 to 4 family reverse exchange or improvement exchange is usually about $5,000 to $6,000 to start and goes up from there. And I would guess on average, my commercial reverse exchanges probably float around $7,000 to $10,000. But again, they're case by case, and it really depends on a lot of factors. So it's hard to kind of narrow that down. If clients have some regular forward exchanges that are smaller, like maybe 300,000 or 400,000 or 500,000, then our fee is usually less than the $1,500.
Okay, if someone's involved in a quick sale, a flip, how long do they own the property to get them into the exchange world without being a broker or dealer, whatever term used?
Yep, so that's a good question. So the IRS does not give an exact timeline about how long you have to hold property in order to do the exchange and not be a flip, but it's how you use it and how you report it while you're holding it. So most often I'll just kind of generally say, you should hold something for a year before you sell it. But if you bought a property and you're developing it and subdividing and whatever, and it's taking a year to get through permitting and city and town approvals and all of that, but your whole goal, you've had like if you lived here, you'd be home by now sign, your mobile home, rental sales, whatever. The whole point from the beginning is to sell it or to subdivide and sell the lots or the units or whatever. the intention was for resale, like to flip, even though a flip is considered short term. So it's really more about your intention. If you bought a property, you leased it out, and then at month 8 or 9, you say, oh, I got an offer I can't refuse, or I really want to buy something else, so I'm going to sell this. But you'd have these lease agreements in place. You were going to rent it for at least a year or longer. That was your intention. You could sell it at 8 or 9 months, and I'd probably be comfortable with that. So it's really more about how you're using it. But as a general rule, I know some CPAs want to see 2 years. They're very conservative. And there are a lot of 2-year rules for other things in 1031. But for the most part, if you've been holding something and leasing or renting it out for a year, we're pretty comfortable with that.
Kind of a spin-off to that question, in the situation of an estate, if someone inherits a property and they get the adjusted basis, do they have to hold on to the property in that situation as well, or can they exchange right away?
So a client has done like the father has done a 1031 exchange, and he owns property and he's deferred the taxes, and he passes away. His heirs, so the property transfers through the estate, like the normal channels, to the heirs. So say the property transferred, so say his basis originally in the property was $400,000, and he sold a property for $700,000, bought another one for $800,000, and he kind of kept exchanging all along. That basis is following him on paper. So if at the end, if he decides, forget it, I'm done, and he sells the property for $1 million, and his basis was $400,000, he owes tax on that $600,000 gain, right? But if he owes his property and it's worth $1 million and he passes away, that property transfers through the estate to the heirs at a value of $1 million, whatever it was on the date of his death. So then if the heirs take that property and sell it for $1 million, they have no capital gains tax due, because that $400,000 basis that the father had rolled up to the value of that property at the date of his death and passed to the heirs. So the heirs get it at a basis of $1 million. So if they sell it for $1 million, no tax due. If they keep it and start renting it, their basis is now $1 million. That's their start point. So later, if they sold it a couple years later for $1.3 million, now they have a gain of $300,000.
Okay.
Does that answer the question? I hope.
Yeah, you did. Yep, perfect. In the case of a Delaware statutory trust, does IPX handle kind of like the sale side of that? How does that whole thing work?
Yeah, so IPX itself does not act as a broker for DST properties. So they're run through the security side. So you have to, there are certain financial advisors who just focus on the Delaware Statutory Trust or DST properties. So, we certainly know some and can connect people if they're interested in that. But we ourselves don't market them. So what happens is that they're very similar to a REIT. So you have the real estate investment trusts where someone might put money in and they buy shares in the REIT. Well, a REIT does not qualify for a 1031 exchange because it's shares. You're buying shares. So these REIT sponsor companies, like right around the year 1998, 2000 and on, started forming these other types of programs, a Delaware Statutory Trust. And so instead of buying shares, the client they put their money in 200,000 or 400 or whatever, they're buying a beneficial interest ownership in the trust, which is a real estate purchase. So a lot of the sponsor companies that are REITs also have the DST programs. And then you have from the security side, it has to filter down. So it has to go through a financial advisor who's working with the DST company. Okay. But I can certainly connect somebody if they're interested. We have some good ones in this area.
What do you think the ratio of the exchanges for people who end up buying residential properties with the idea of doing the 24-month rental and then eventually converting them to personal use?
I don't know a percentage, but I would say there's a good amount of people who have that plan in their head.
Yeah.
You know, the ruling on vacation and second homes went into effect in 2008. I mean, I guess I would say probably a good 20% of people, 25% maybe, do try to do that at some point with their exchanges. That being said, we have a lot of clients who are commercial clients, so that's really not what they're looking at. But of the clients who do residential exchanges, you know, I would say maybe 20% or so, maybe a little more.
Just as a plug for you, I've spent a lot of time on your website, and the webinars and the other information you have is really helpful. Do you guys keep adding to that? Is that something that we should continue to check?
Yeah, thank you for mentioning that. We have a great department who manages all the website and everything in our materials. If you go to IPX1031.com, there's a section called resources, and I'll send everyone on the call tomorrow. I'll send them our brochure and a couple of PDFs that would be great for you to have on hand. But you can do, there's tax calculators in there. There's 45 and 180 day calculators in there. I told you about the tax reform button if you want to get linked in, try to keep getting information on tax reform as it becomes available. But it really is meant to be interactive. We have a lot of videos on there about different topics. You can just click and watch a video. You can go to sign up for newsletters, and you can either email me, or you can go right to our website. And if you look for Patricia Flowers, you can sign up. We do one newsletter a month. We do not bombard people. I certainly don't nag anybody, but we have great newsletters that are on hot topics. So if you want to link into any of that, it's IPX1031.com, as I mentioned. And I just sent through the chat a link. And so we've been trying to also kind of upgrade our presence online through like Google and webline presence. So if you all get a chance to, I'd really appreciate if you click into the chat right now and just click on this link. We're just doing some Google reviews to try to get the word out to people about 1031 exchanges and about, you know, what the options are, and try to drive something to drive them to the website and into any 1031 website for that matter, just so they can understand the tax benefits, because it really is a great program. And the most heartbreaking calls I get several times a month, if not more, is a client sold property. They had no idea they could do an exchange, and now it's too late for them. And they're very upset with everybody because no one told them, quote unquote. No one mentioned it. No one brought it up. So I feel like for you as brokers, you know, you're on the front line there. You're talking to them first, maybe before anybody. It's such a good tool to be able to share with them, and for yourselves, of course. And I just think in general. So if you don't mind clicking on the link, trying to leave a little, if you thought today was a good presentation, we'd love for you to leave a review. It really helps for marketing, but it also helps for clients out there who are just searching 1031 exchanges for information to pop up for them as well.
That's pretty much the end of the questions.
Okay, great. Anyone else in the chat? Everyone's had everything. I think we've covered everything that was in there. Thank you to my assistant, Vanna White, Steve Kirby, and Jack for your wonderful events and help. I really appreciated being able to do this today. I'm really thankful. And like I said, anyone's able to call me anytime, email me anytime. Jack's going to send me a little list tomorrow or over the weekend. And I'm just going to send out to you our brochure so you have it. I can send you the PowerPoint if you want. And again, you can call anytime or email if you or your clients have questions. I'm happy to help.
We'd like to thank you too, Pat, for doing this. Hopefully it gave everybody a lot of information that we can use to go out and make some more money. Also, again, want to thank Steve for helping with the question and answering and leading that part of the session. We think these are very educational and can be helpful to our members and anyone who's affiliated with them moving forward. Our plan at this point is to run one of these on the second Wednesday of every month. We have programs on SBA 504 And we're trying to put together a annual market review, which we're in the process of putting together. Again, thanks to Patricia and Steve and Jack. I think that's it. Thanks everybody for attending. If you're interested in RICABOR, Jack did put his contact information in the chat. Please reach out to him. And that being said, everybody have a great night. Happy holidays, and hopefully we'll see you in January.
Right.
Thanks, everyone.
Night.
Great. Thank you very much. Take care.
Bye-bye.